Good day, traders. Stacey Burke from Stacey Burke Trading today, continuing our discussion on first red days, narrow range days, inside bars, essentially looking for areas or setups where the market has potentially either trapped volume up high or down low for an explosive move, or had an explosive move and then coiled into a reversal pattern, trapping volume again either up high or down low, and setting up properly heading into the next day for a strong impulsive move that virtually does not have a lot of heat or stress in entering or holding on to the position. And again, these are the types of trades I like to look for. We're going to look at some examples that happened in the last week: pound, euro, Canadian dollar, and how they set up, how the different variations they were, and also at gold today. Some fantastic setups. Again, just an example of how when you're looking for certain types of setups, how the other time frame or technical analysis that retail traders use can sometimes mask or hide or prevent them from seeing a golden opportunity because their other indicators or time frames are not in alignment with the setup that might be about to move very strongly. So today, looking at gold, we had an explosive move up on Monday after a narrow range coiled week heading into the beginning of the session. But we'll talk about that in a different video. The strong move on Monday was our initial burst. And then Tuesday gave us our first red day after an explosive move. So we've talked about looking for a large range day. So again, the gray line is our Friday separator. But a large range day and then a first red day. Now, this can also work, obviously, in looking for the first green day for a long position, but we're looking at this is a trigger for us to go and pay attention to how that market has created this first red day, and we go to our smaller time frame. So we go to our first red day after the explosive move. You can see the market was moving in 100 pip boxes virtually, clearing double zeros, exploding in the U.S. session, and then consolidating under 50 after the U.S. close. We had an engulfment, trapping or shifting volume up above double zeros, and then yesterday's trading range was largely in a 75 pip box, and for the bulk of the day, shorts were being created underneath a 50. Then the market exploded above in the New York session, hitting stops, triggering breakout orders, but then engulfing above 50, and then into the close, giving us the 33 style setup before taking out the low of the U.S. session into today's range. Now, obviously, as we headed into the close, we had a breakout of that last higher low, then the three lower pushes, the 33 setup heading into the new day. We have a death line or a neckline, whatever traders want to call it, that if this market closes through this lowest boundary of the previous narrow range day, this volume is now all trapped up above the double zeros. So our first red day is, of course, the day that after an explosive long day, a day that closes below its open, which we got. The second criteria we're looking for, number one, let me restart that. Number one, we want to see a large range explosive day. So we had that 250 pip move up. It was actually 300 from bottom to top almost. An explosive move up, and then volume being contained up top, and then the close below the open, and then the break of the neckline, the death line, whatever we want to call it. Our next potential level of support was a minimum of 50 pips away. Now, I know people will say, well, there's, orders in here, liquidity, blah, 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 blah. I'm just talking about my approach to the first red day setup, what I'm looking for. And this is a trade that when you get this right has the potential to be able to scale up in size. Now, if we break this down even further into a smaller time frame, if we look at the 5 minute, for example, we see the break of that last higher low prior to the close, and then where that move all began prior to the three pushes up, and then of course the break of the low of the U.S. session. So this is prior to our 12 candle window beginning. So again, coming back, we have our death line or our neckline down at 12.07 in that area. And now this is textbook because we talk about this on a second day trade, the narrow consolidation. The day starts out and creates a high, creates a low, and at the same time triggers a breakout of the U.S. session low, as well as hitting stops, pulling back, and then continuing to drop down. Now again, looking at our 15-minute chart, if we just zoom in here again, I talk about engulfments and pin hammers. Now this is the pin hammer at the first bar of the session, a first bar trade in our first red day, after our first red day, after the breakdown and triggering of the previous day's low in a narrow range pattern within a pattern. So again, I'm showing you this because this is a great variation where traders are looking at this as a long bull candle, but this is a reverse bull pin, pinning the top, stop on traders that are in first mouse, breakout pullback, and then the continuation. So retail, a lot of retail will chase that move. The smart money is already in up top. And on the 1 minute time frame, we had a pullback into the quarter level and then a continuation that created this not only 15-minute pattern, but the 5-minute bar as well. Now this market continues to fall. If we take a look back, again coming back, we see the reverse bull pin hammer here. First bar of the New York 12 candle window on Monday night after they went above the double zeros in a trending day. Breakout pullback, bull pin hammer, first bar for the explosive 150 pip move up. So first red day, again, let's review. We had the explosive move up on Monday with large ranges creating that space, trapping volume up top, peak formation low, peak formation high, dropping down into the close, taking out the low of the U.S. session, pulling back, closing below the death line, the neckline, and then dropping like a stone. Again, just looking at our 1 minute, again, we had the entry level on the stop hunt back up to the quarter level for traders who are entering it on the pop-up, on the pullback to the numbers. We have traders who may have followed this through on the break of the rectangle in between. And this market had an explosive move straight down to 50. Now, again, understand the criteria that this set this trade up. First red day, we came to the market looking, already expecting to see the possibility of this trade. Explosive move up, large range day, then a narrow range day. Narrow range day. For gold, 100 pips is a narrow range day. Let's take a look at the pound. Last Friday, we had a large range day up, and then we had a red day on the Monday morning. Now, this is a different setup to the euro, but again, just looking at this in context and understanding, we had the first bar of the month. They pinned up and hit stops on the lower high. They pull back, they work back into that short trade. They drop down and work back up again without following through. We have traders in long on the bullpen. So again, we know traders are chasing this move back to the high. We get our first red day on a Monday. So we don't know if this is a trade or not, but we go back and we look for that same criteria. We want to see a large range day. We want to see a red day reversal where we have volume trapped up high or down low if it's a green day. And then also that criteria, peak formation high, peak formation low, that sideways rollover down in towards the low if it's a short day, or up towards the high if it's a first green day. So again, looking at the Friday, we can see a similar scenario to gold. Large range day with not a lot of pullbacks. It's a vertical move. Then the market proceeds to hold volume above the 50 level throughout the day on Monday before breaking the structure in the U.S. session and then petering out down towards the lower side underneath of the low of London and then heading into the next day. So we have volume trapped up high above 50. Obviously, in the last leg, they've dropped it down below 50, below in between 25 and the quarter level. But we see, again, important to understand the first reference point of this, our death line, is the low of Friday. It may fail at this level, but we can certainly see a retest of this level and also where that move began. Engulfment, bull pin, hammer. So double zeros is a a target straight off the bat for 25 pips. We see our reversal, peak formation low, peak formation high. Then it struggles to follow through and heads towards the low. We break the low of the U.S. session as we saw in gold. A little different scenario, but same characteristics. They break the low. This volume all above the low of the U.S. session, N50, is now trapped. So if we project this back through to the Friday line, we know all of this volume after a close below this line is now caught up high. We head into our Asian session. The market follows through down before making a low in the gap time and then following through at the beginning of our 12 candle window, bear pin hammer, breakout, pullback. Now there are two types of scenarios that I would look for in a trade like this. One is a measured move of the low and high of that narrow range day, which we can see obviously the market fulfilled that on the day following the first red day. Or we can strictly just look at the numbers and say this is a 50 pip box. I'm looking for a 100 pip move. Quarter to quarter level, that was a 100 pip move down. First red day. And just to follow through up on that and using the calendar to understand this. Day 1, day 2, we had the Fed on the Wednesday midweek reversal in some cases, or midweek continuation. So the market works back and forms a first green day. First green day in a downward moving market. This would be a Brooks H1, one bar pullback, whatever you want to call it. But then the market the next day proceeds to follow through, break not only the low of the U.S. session, but in the Asian session, trade through the low of London. So again, this is not hindsight. We're coming to the screen after this has happened. We're coming to the screen after the first red day, looking for this opportunity. I'm looking for big moves and then a red day. Big move down and a green day. Well, now we're in a trend trade. So if I'm going to be trading this, I'm going to be in line with the original move down. And again, just talking about measured moves, one full expansion of that range, of that high-low, narrow range or pullback day. So again, taking a look at the euro, we had our large Friday move up last week. First red day was on Monday, same scenario as the British pound, but obviously different price action on the daily chart. And again, the low of the month. So we get our first red day after a vertical move on the Friday back up, possibly looking for a retest of the low in a downward moving market. Now we had, this is talking first red day in a narrow range bar at the bottom of a range, which preceded the large move up. And we'll look at an example on the Canadian dollar as well. So again, a narrow range NR4, NR7 type setup. We'll get rid of that. Bring this over. NR4, NR7 inside bar, explosive move up. So again, using the daily charts to help spot these trade opportunities. We get our first red day on the Monday, and then again we go to our daily chart, or our 15-minute chart. We want to know, we've had a vertical move, how clean is that vertical move? Do we have a peak formation high, peak formation low reversal type setup up high, and is there volume trapped on the wrong side of this move? So when we go to our 15-minute chart, we see a nice clean vertical move on the Friday. Tick number 1. We see a peak formation high in Asia, then a peak formation low in the U.S., locking in our high and low for the day and the session. We see the market head sideways into consolidation in a narrow range. We have our high and our low heading into the Asian session. The market works its way down, making a new low. We get a breakout of our narrow range rectangle after our first red day, down low at the quarter level. We see a vertical move back up, stop hunting the lower high of the day and the lower high of the U.S. session before engulfing, and then trading back down into the previous day's low. As we head into the U.S. session, we get our pop-up bull candle pullback. It drops down below into the lower creep, heading towards the low of the day. Breakout traders would have entered in on the bear pin close, and again, this is a 15-minute chart. They could zero in on a smaller time frame. Other traders would have been already biased to the downside because of the short trade off the high of the day, dropping down, going sideways underneath the peak formation, bull pin hammer heading into the U.S. session 12 candle window, taking out the higher level longs. hitting stops, pulling back, pinning into traders who are already short before continuing that move down. So again, coming back and just looking at our narrow range day, inside bar in this particular case on the euro. So not only a first red day, but also an inside bar. So other time frame traders would have entered in on the break of the outside bar down below the low. We'll just zoom in on that. So we got inside bar traders in the market, which is potentially why we see that stop hunt back to the high of the day, putting heat on traders that are now short end of day, 4 hour, 1 hour, whatever, before continuing that move down. And again, talking about our neckline, our minimum target would be the low of where that move started. And we can see that that market continued to work its way down over the next couple of days for a 100 pip move down. Now, if you're out on the end of the session, understand the concept, what these trades offer to traders. Explosive trades that do not come back, meaning there's zero heat. If you're trading in stuff like this with size, I don't know, you're going to be back and forth, back and forth, back and forth. We're looking for a market ready to coil and explode, move 50, 75, 100 pips, maybe more in gold, and not come back. You're in size, you're in profit right off the start of the trade. You're at break even and you're taking partials off maybe, but you're making money right from the start. You're not sitting under stress. You're not sitting at the screen for 5 hours hoping it moves in your direction. These are trade setups that are scalable in size. So if we take a look at the Canadian dollar, again, a market that has been offering some fantastic opportunities. On the Friday, we saw the double inside bar narrow range consolidation at the low of a range. And again, this is using scans or just your visual checking each and every day on the daily charts for these opportunities. We have an inside bar, then we have the narrow range double inside bar heading into the Monday session. So again, similar to first green day, first red day, these are markets that are coiling now potentially with volume trapped on the wrong side of where the market is about to explode. We're looking for the same criteria, a vertical move and volume being trapped, and then a reversal scenario in that day that is our trigger day. Another important criteria to tie in with some of the U.S. major pairs is taking a look at the economic calendar. We had Canadian news on the calendar for that week. So just taking a quick glance, we had the CPI and the U.S. Fed on the Wednesday morning New York time and afternoon for the Fed. And the Canadian CPI is a potential mover. We had retail sales, so there was news that could be affecting the Canadian dollar this week. So going back and looking at the move that precipitated the narrow range consolidation and double inside bar, we had a vertical move on the Tuesday vertical move down, a followed through vertical move on the Wednesday. Thursday, a narrow range first red day against a strong downward move, and then a market that failed to follow through on the downside, also creating a first green day on the Thursday and a first red day on the Friday after a narrow range day, but that's a double inside bar. Double inside bar after a large vertical move down. Now let's go back to our original criteria. We want to see volume trapped on one side of this trade. If the move started up top here, and they've put a low in place, where is the volume trapped? Is it trapped up here, up top? Is the volume trapped up top? Or is the volume trapped on the downside? We have a double inside bar with volume trapped on the downside. We have lower highs and then the double narrow range day. So just in simple terms, just even with the box that I've drawn, we've got a 25 pip box at the bottom of a range where volume is consolidated. And on the Monday, we break out of that range. So we now have a breakout on that narrow range day. This is a day zero type setup for an explosive trending scenario. And again, our first target is going to be going back up to where the move started from. This is our anchor point. So I had somebody say it a while ago, what's this term anchor point? Anchor point, neckline, death line, whatever you want to call it. That's where the move started. That's our target. That's minimum of 75 pips back up to the high. But again, if we break out of this range, we may be in a measured move scenario. So this is where traders who have their EMAs and their stochastics and all these other indicators on there, that this is your trend day that continues into a second day trade. and understanding that a double inside bar can precipitate a very large reversal type move. So a fantastic setup on the Canadian dollar, double inside bar. And again, just looking at our timing window, the market bang breaks out in our Asian session, continues to trade in the gap time, forming a new high of the day. We head into our Europe-London window, continues with a bullpen double bar engulfment. They break out, pull back, and continue the move. Again, a bullpen off the low of the session. So low of London, low of London, Europe, makes a new high, pulls back to the low of the current session day inside of a peak formation low, and then breaks through 50, pulls back into 50, engulfs. So this is all the type of stuff that traders you need to be, or you want to be studying to watch how price behaves at highs and lows. It engulfs at 50, major round numbers, with a high above 50, which means there's stops up there, which means if they break this, we're going to potentially hold this level now and head up to double zeros. U.S. session continues, pulls back, continues the move. We trade sideways at the quarter level heading into the new day, and the trend continues up towards the double zeros. We break through double zeros, and the move continues. So again, double inside bar, first red day, first green day, first red day, a double inside bar, and then a retest of the anchor point, trapping volume down low. Large explosive move, consolidating the volume. The news may have accelerated this move already in progress. It may not have, but we head into the Wednesday, we see the CPI, Canadian CPI, and then the Fed accelerate this again into a second day trade, and we virtually have a market that's trended from Monday to Friday, pretty much, until they put in the peak formation high. Now, again, this is a market that can set up for large moves in both directions. When we see this accelerated blow off into the third level, 1 push, 2 push, 3 pushes, and then another example of even just understanding sessions. First red session after 2 green sessions at a peak formation heading into the new day. This market now has volume trapped up top underneath the low of the day. So not quite a full first red day, very close, basically a doji, but again understanding that volume is trapped up high after a vertical move of 5 days trending into a peak formation, breaking through the low and falling through all of these higher level longs that have been caught chasing the move into its last stage. So hopefully you got some value from today's video, traders. Narrow range days on your daily charts, double inside bars, NR4, NR7. That just strictly means narrowest range in the last 4 bars, narrowest range in the last 7 bars, double inside bars, first red day, first green day. So keep it simple, stay disciplined, stay focused. Use these bigger time frame charts to help identify explosive, scalable, highly profitable trade opportunities. Have a great session. Thanks for hitting the like button, and may the markets
Hi
go
traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.